Vishy, right now on the strategy, we have heard guests parlor a 10-year yield to 3%, or dare I say beneath 3%, and others with fear in their voice, price down, yield up. On a sum basis, 12 months out, where's Morgan Stanley?
We are closer to 3%. End of the year number for 10-year treasuries is 3.15% is our base case forecast. So I think we are closer to lower from where we are. And I think 4% is going to be a huge stretch. So lower from where we are.
That said, you can see that the data keeps coming in persistently strong enough to keep things on track. It seems like the banking crisis was not a crisis, at least in the way that people were worried about. At what point do you start talking about reverting back, as John was talking about earlier, to pre-March 8th, to this idea that perhaps this economy has enough heat in it to sustain higher yields for longer?
I think a few things to keep in mind there, Lisa. I think even though we have not had any new bank failures in the last few weeks, the fact remains that the banking system as a whole, the dependence on the Fed facilities, the discount window, the BTFP, the Bank Term Funding Program, is still pretty high. It's around 140 billion of borrowing is happening, and that to us it suggests that there is still a lot of residual tension are related to liquidity within the banking system. So that does not indicate to us that the banking challenges that we're facing are behind us. Also keep in mind that the effect on tightening of financial conditions, that is in addition to all the monetary policy tightening that we've had. Tightening of financial conditions that comes from a more restricted credit supply. I think that is yet to be played out, and we will not be so confident that the challenges from the March in the banking sector are behind us.